Hello everyone, a very good evening. Welcome to the first lecture of our capsule batch for Module A. And for those who have joined us on the YouTube platform, this is a demo session. This session will be on your YouTube channel, and then all the remaining capsule batches will be on the Oliveboard platform. All right, so I hope the audio and video is fine, everything is okay, and we can start with the session. Good evening, good evening. So we are starting with the module A today. Module A has 4 units, very simple module, very easy module, 4 units, introduction to retail banking, role within bank operations, applicability of retail banking concepts, and branch profitability. A few topics from numericals are also asked. Okay, so you can expect around 10 to 15 marks from your module A. So 10 to 15 marks is the weightage. All right. So what we are going to do, we'll be revising each and every topic which is important for your exam, covering all the units. And I'll be going a bit fast because obviously we are revising. After every important topic, I will ask you if you have any doubts. I will repeat the topic. After completing every unit, also, we will have a small break of 1 or 2 minutes, and then you can ask me queries. All right, so let us start. First unit of module A is the introduction to retail banking. Very simple. What is retail banking? When the banking products and services are offered to the individual consumers and the small businesses. That is retail banking, as opposed to wholesale or corporate banking, where the large customers are there. When the banks they deal with businesses, corporations, governments, that comes under wholesale banking. Retail banking, the clients are individuals, small companies, MSMEs, agriculture loans, etc. All right. Also, under retail banking, there's no restriction on the products. Both asset and liability side product, as well as the other services, third party products are also offered in retail banking. Okay, so what is the definition of retail banking? Refers to the provision of banking products and services offered to the individual customers, typically non-entrepreneurial purposes. Now, individual customers will also include the small companies. Do not get confused here. Not only individual customers, but also small companies and for the non-entrepreneurial purposes, basically for their personal uses. For their personal use. Good evening. All right. So, both on the retail side, we have the liability products and the asset products. Liability products are the different types of deposits. The savings account, current account, fixed account, recurring deposit, all the types of deposit they come on the liability side. Then retail asset products, all the types of loans come under the asset side. The home loan, education loan, car loan, professional loans, home improvement loan, everything. Other than this, we also have other services, support services. Banks, they also offer the insurance products of the insurance companies. They act as brokers. Banks, they also offer mutual fund products. Banks offer locker facility. They distribute the credit cards. Banks, they also provide advisory services, tax planning, retirement planning, portfolio management. So these all services, when they are provided to the individual class or the small companies, small corporations for non-entrepreneurial purposes, then it comes under retail banking. How is it different from wholesale or corporate banking? This detailed topics is there in your unit 3 that we'll be covering. Okay. Next, very important topic, very important, the distinction between mass retail banking and class retail banking. Mass retail banking means when there is a large customer segment, standardized banking products. All the banks they offer a savings product with the same characteristics, right? To inculcate savings habit among the customers. Okay, and they offer the withdrawal on demand through various methods. They also offer the mobile banking facility, internet banking facility. So, standardized banking products and services to all its customers. There's no differentiation. There's no customization in the mass retail banking. What is the purpose or objective of mass retail banking? This is the first stage. First stage of retail banking. Basically, the bank is trying to build a broad customer base. Whenever someone starts a new business, they offer some freebies, they offer some concession, they offer buy one get one facility. Why? Because they're trying to get more customers, they're trying to increase their sales. Once they have these customers, then they will offer the customized products, they will increase the price. Okay, so first stage, we are trying to get a large customer base, sufficiently broad customer base, so that we can get a stable source of funding. Then we move on to the second stage of retail banking, which is known as the class retail banking. Now, once we have the customers who are loyal to the bank, who are not going to shift from one bank to another, then from those customers, we select the high net worth individuals, those who have a higher salary, who can avail fee based services, right? To them, we offer customized products and services. Niche customer segment means the high net worth individuals. So when we are starting, we first have the first stage, mass retail banking. Then we move on to the second stage, which is class retail banking. What is the purpose of the first stage? To provide standardized banking products and services to its customers and build a sufficiently broad customer base to get a stable, regular source of funding. Class retail banking, what is the purpose? To get fee based income, right? Offering customized products and services to the niche customer segment, the high net worth individuals. These two stages are extremely important. And then one another important point, retail banking, which is focused solely on the niche customer segment, may also be termed as private banking. To these private customers, we offer all the customized services: tax planning, retirement planning, portfolio management, investment management. These services are offered to the niche customer segment who are ready to pay a higher fee to the bank. So banking can be divided as banking for individuals, under which we have retail. We have two stages, mass retail banking and class retail banking. Under the individuals, we also have entrepreneurial for agriculture and MSME. Both of them we are focusing here. And then banking for firms can be wholesale firms or MSME. This is not the focus of retail banking. All right, so I hope the meaning of retail banking is clear. Okay, then we have characteristics of retail banking, a very simple generic topic. It is targeted at individual customers or small organizations, meets the need of large number of customers who have diversified portfolio. Now, the customer who visits a bank, they will have more than one needs. They would want a deposit product, they would want to open a FD, they also want to take a loan from the bank, they also want to hire a locker, they want a locker, they also want to ask bank about the insurance products. So they have diversified portfolios. And retail banking, they offer the multiple products, right? Multiple products to the multiple customer segment through multiple delivery channel, right? Offers different liability, assets, service products. Delivery model is both in physical and virtual, not just digital or mobile banking, but physical. Also, physical includes not just a branch, it also includes the ATMs, business correspondents, business facilitators, and services are extended not only to individual customers but also to the small and medium sized businesses as well. Okay, so these are the characteristics of retail banking. Now, if we talk about the evolution of retail banking in India, after our independence, basically the banks were focused on the large customer segment. So our banking was wholesale banking. Focus on retail banking was introduced in India by the foreign sector banks, and later on it was inculcated by the private sector banks. So two names you need to remember from here: the Standard Chartered Bank and Grindlays banks. They were the pioneers, they were the evolutionaries. They introduced the products basically catering to the individual segment. Citibank, the first bank to introduce their credit card products in the 1980s. Then, seeing the benefit and growth of retail banking, various Indian banks also entered the segment. We have the State Bank of India, Indian Overseas Bank, Bank of India, Bank of Baroda, Andhra Bank. These were the early players. Bank of Baroda and Andhra Bank, the early players in the credit card business. So these are just the factual things, right? Nothing to understand, factual things, easy things that you can remember. If questions are asked by the institute, they will be of point 0.5 marks. All right. Next, now certain points, this I did not, I wasn't including it in the previous sessions of exam, but in this session, various case studies have been asked. Case studies in the format, they will give you a scenario, and then the institute will ask you what decisions should the manager, the marketing manager, or the director should take, right? So to understand and answer correctly, you need to read just the pointers, just the head, right? What are the prerequisites for success in retail banking? There should be an efficient delivery mechanism. Retail banking includes the old generation customers who prefer the physical modes, direct communication with the staff. Also, we have the tech savvy new generation. They would prefer mobile banking, internet banking, anytime, anywhere, anyway banking. Direct banking is the fastest growing dominant channel of the future. Direct banking includes not only mobile or digital banking, it also includes ATM. I want to check my Aadhaar seeding status, or I want to change my account pin through ATMs, call, email centers. So that these are included in direct banking. Product appropriateness. The bank should have products that they offer to the customer, and those products should satisfy the customer. Okay, then pricing should also be appropriate. If the product is beneficial but the price is too high, the customers will not afford it. Scoring model should be there. We'll be studying in our next module the credit scoring, right? The scoring models based on past history, current dealings, the types of loans availed, secured, unsecured. There should be a good scoring model to assess the credit worthiness, and a consumer protection environment. What should be the liability of the customer in case of an unauthorized transaction? How can the customer reach the bank in case of an unauthorized transaction or losing their debit card? All right, so these are the points required for success of retail banking. What are the challenges for retail banking? Again, let's say the question asks you, a well-established bank wants to set up a new branch in the urban center, in a metro center, right? The marketing managers are faced with the challenges of introducing the branch. What factors should they consider? So, consumer protection and pricing, protecting the customers from the undue risk, threat, third party breach, identity theft, right? Data hacking, phishing, wishing, then inadequacy of management information system. The banks will take decision from the data that they collect. Data is collected through blockchain, data is collected through data mining, big data. So if there is inadequacy, wrong decisions will be there. Understanding the KYC, AML issues are important. Managing the different types of risks faced by the bank, credit risk, reputation risk, market risk. There can be effect of new technologies. The technology is evolving, and the banks, they need to inculcate this new technology so that the customers can be satisfied, and continuing growth is important, right? Then what is the future of retail banking? We'll be seeing growth in digital banking. Right now, also the demand for digital banking, mobile banking is ever increasing. rapid adaptation of blockchain by retail bankers, artificial intelligence. We have studied about the different chatbots that are developed by the banks. Sia is there, Eva is there, right? Artificial intelligence can also be used for detecting any anomaly, any identity theft if someone is trying to get unauthorized access into the computer system. All of these areas are there where artificial intelligence can work. Cyber security should be a top priority. Payment innovations should be introduced. Not only QR scanning, smart watches are there, wearables are there, rings are there, and a rise of big tech in banking technology. So there's the concept of fintech and TechFin, which is also important. So the big technology joints, they are also entering the banking space, they're providing the financial services. All right, so these are the basic generic things from our unit 1. What are the advantages of retail banking? Client base is large. There is a large customer base, right? We are offering products and services to more than lakhs of customers. Only a few of them would be defaulting. So if a bank gives a home loan to 100 customers of low ticket size, the possibility of default will be only 2 or 3 if proper monitoring is done, right? So the customer base is large, so the risk is widespread. Customer loyalty will be strong. If the customer is satisfied by this home loan and later on they want to add another floor, they want to do some renovations in the house, they will approach the same bank because they're satisfied with the behavior of the staff, with the products offered by the bank. If the customer is availing a home loan and they want to take an insurance product for their home, again they will approach the same bank because they'll be offered some concessions anytime query resolution. So the customer loyalty will be strong, the customer will not shift from one bank to another. Attractive and wide interest spread. What is the meaning of interest spread? Banks, they earn interest on the assets, on the loans they create, and the banks, they pay interest on the deposits. Now, if the banks are able to create more savings or current account, they have to pay low or no interest, right? Let's say they are offering 4% interest on the saving deposit and 0% on the current deposit, and on the loans that they are giving the bank can charge, let's say, 9% interest. So the interest rate spread will be 5%, it will be positive, right? And the customers are too fragmented, we have a large customer base, they are too fragmented to bargain effectively, so the banks can charge a higher rate of interest. This is another advantage of retail banking. Okay. Also, the loan amounts are relatively small. Low ticket size of loan is there. So even if the customer defaults, the bank will not face a very high loss as compared to corporate banking, where the loan amount is comparatively quite large. Okay. So these are the features, meaning, basics of retail banking, and we are done with our first unit. Before we start with the second unit, if you have any doubts, any query, if you want me to repeat a topic, please let me know. Otherwise, give me a confirmation so that we can move ahead. Those who have joined on the YouTube channel, you also, please, if you have any doubts, feel free to ask. Also, like the video, share the video with your other fellow aspirants so that they can also be a part of this discussion. Like the video, everyone. So everything is clear? Those who are here on the paid platform and on the YouTube channel, everything is clear? We have a lot of time to complete our module A. So if you have any doubt, please ask. Okay, clear, clear, all right. Okay, so now we are starting with our second unit. Second unit of module A, retail banking role within bank operations. So this unit is also important. Basically, we need to study about the strategic business unit approach, departmental approach, and the integrated approach. Basically, when the banks are offering the retail products, when they are entering the retail banking segment. What should be their strategy? What should be their approach towards the retail banking? So usually three types of models have been introduced. Okay, now before we move on to the theoretical part, just try to understand this. SBU, strategic business unit. If there's a bank, let's say ABC Bank, right, and they are dividing their organization on the basis of the various products they're offering, so that is the SBU. So there will be a different retail branch, corporate branch, MSME branch. Another branch could be there, let's say, offering only rural banking, right? When we are talking about these branches, all the decisions related to the retail banking products will be taken by the SBU of retail banking. Corporate, MSME, rural, these units are not going to interfere. So each of these SBUs, these are completely independent, right? One unit is not going to interfere in the decision making, in the functioning, in the management, nothing. They are completely independent of each other. And these units, separate units, are known as profit centers. Don't worry, everything I've provided in the notes, so you'll get it. You can have the notes for your revision. I'm just writing it down to explain, right? So these units are known as profit centers. The retail banking profit center will focus on the creation of the retail product, on the marketing of the retail product, on the pricing, on the management, everything of the retail product. They're not going to take any part in the decision making or management of the corporate side or the MSME unit. Okay, so this is the strategic business unit. Each business unit is a profit center focusing on the particular product offering. They will not interfere in the other unit, right? This is the SBU approach. Then second approach is the departmental approach. What is the meaning of department? Here, horizontal classification is there. There will be, in the banks that you are working, there's an accounting department, there is a management department, there is a pricing department. Another department will be based on the management information system. So here the organization is the same, it is unified. Profit centers are not divided. The organization is still divided on the basis of the functions that each department performs. So the departmental approach is also known as functional approach. All right, functional approach. Okay, so the organization is divided in the SBU approach. In the SBU approach, as per the profit centers, the organization is divided in the departmental approach as per the functional structure, function that each department performs. Right? So the same department, the accounting department, will be looking after the accounting of retail products, corporate product, MSME product. The management team will be looking after the management of retail, corporate, MSME. Similarly, the pricing will be done by the same team for the different types of products. Okay, so division is there in both SBU approach and departmental approach. The basis of division is different. In the SBU approach, it is profit centers independent. In the departmental approach, it is functional. The function, the role that each team or each department performs. And then there's a third approach in which there is no division, right? Overall business strategy, a unified business strategy is followed in the integrated approach. Usually, integrated approach can be adopted by the RRBs or smaller businesses, but not by the large public sector or private sector banks. Okay. I hope the definition, the meaning of these approaches are clear. Now let us move on to the theoretical part. What is the SBU approach? It aims at dividing the business on the lines of the strategic business unit. Now, how will the institute ask you question? Institute will give you which of the following statements are true about the SBU approach. or the institute will give you the various definitions, the various characteristics, and they will ask you, they will say like ABC Bank has divided the business on autonomous units. Each autonomous unit is a profit center. Which approach is the bank following? So it is the strategic business unit. Aims at dividing the business on lines of the strategic. Each business unit has its own strategy, completely independent of the other business unit. So they are autonomous division. Autonomous division means they are independent, they are small enough to be flexible. They are flexible in their own terms. They can select a pricing strategy. If it is not working, they can change their plan within the SBU, within the business unit. And they're large enough to exercise control over all the factors. What are the factors affecting long term performance? The price of the product, the process of the product, the promotion of the product, people, place, everything, right? What is the difference between departmental and integrated approach? Okay, let me just cover it. I will let you know, right? So SBUs, they are what? They are profit centers. They offer, they focus on one product offering and the market segment, right? So the SBU can be a business unit of a large corporation or it can be a business in itself. They are profit centers, autonomous division. They they have complete control over all the factors. Now coming to your question, difference between departmental and integrated approach. Departmental approach, the organization is divided on the basis of functions that each team perform, right? In the integrated approach, there is no division. We do not divide the organization. Neither the organization is divided neither on the basis of profit center nor on the basis of department. Let's say there's an organization, there's ABC Limited. Only five people are there. They are working as partners. Each of these five people together, they will take decision on the process to be followed, on the pricing to be done, on the product to be offered, how the promotion is to be done, right? So they have a unified approach. They do not divide teams, they do not divide profit centers. It is unified, integrated. All right? Clear the difference between departmental and the integrated approach? Hello, Ajay. Hello. Good evening. Okay, great. What else? The strategic business unit. Now, which category of banks they adopt the strategic business unit? Mostly it is adopted by the private sector banks and the large public sector banks. Okay. Also the foreign sector banks, if we are categorizing, some foreign banks might also follow the SBU. Otherwise, there's no particular business model followed by them. So the SBU, large public sector banks, they are following the SBU approach. The private sector banks, the new generation private sector banks, they also are following the strategic business unit. Okay. Foreign banks also, they follow the SBU approach. Now keep one thing in mind. The SBU approach is what? It is technology driven, it is data driven, it is tech savvy. It seems to be something new. Okay, so seems to be something that the Gen Z would follow, right? Having complete control over all the factors, having complete independence. They do not want to be dependent on others, they do not want to seek permission of others, right? So mostly the new generation private banks and the foreign banks, they go with the SBU approach. And the large public sector banks, they might also adopt the SBU approach, right? Another important point, from module A, you can expect around 10 to 15 mark questions. 10 to 15. All right. Yes. There's a concept which is known as management by objectives. Each SBU, each SBU will have its own goal. They will have their own discrete marketing plan, specific product and market segment. So this is the objective. They carry on their management by the set objectives, right? So the SBU follows management by objectives, where the business model has a modular strategy, achieving the targeted profits within a particular module. And if the retail plans do not work, then we knock down the module, as is done by the foreign sector banks. Right? Foreign sector banks, they enter the retail banking space with a particular goal in mind, that in the next 5 years, this will be the profit. If they are unable to realize it, they will exit the retail banking space. Okay. So if the institute, if you see any question with the term management by objectives, just close your eyes and mark SBU. Okay. Doesn't matter how lengthy the case study or the scenario is given to you, just look for the points. Look for the important points. So if you see management by objective, blindly follow SBU, it will be the correct answer. All right. Or if the term autonomous unit is given, independence is given, profit centers is given, these are the points highlighting the SBU approach. Coming to the departmental approach, we do not divide the organization on strategic or business line. The organization is divided on the basis of the functions that each team performs. So it is a functional approach. Now, if in the scenario the term functional approach is given, go with the departmental approach. All right, it is a specialized functional approach. So there are various departments in an organization: accounting department, marketing department, finance department, planning department, right? Separate units are not being set up. They're not being given a particular goal that you focus only on retail banking, or you focus only on the small farmers, or you focus only on the large farmers. No, no such demarcation is there. The division or demarcation is on the basis of the function that each team perform. Like if I'm working in this organization, one team is responsible for the technology, other team is responsible for the marketing. We as faculties are responsible for preparing the content and delivering the classes, right? So these are the departmental approach. Okay. Then, if we talk about the department, every department has its own manager and a chain of command. Now, which type of banks follow the departmental approach? The public sector banks, right? The public sector banks for the retail banking model, they have generally adopted the departmental approach. It is a general approach. Retail banking is not treated as a separate strategy or a separate objective. It is one of the business model. It is not a focused business model. Another difference: retail banking is a focused business model in the SBU approach, but it is a general model, one of the business models in the departmental approach. All right. So this is the difference between SBU and departmental. Public sector banks, they have adopted a departmental approach. Old banks, the old generation private banks, they also use the departmental approach. Rather, they have a conservative approach, right? The business model is a part of the overall business plan, not done as a separate departmental activity, not neither a SBU is created. All right. So if we talk about the adaptation, so the new generation private sector banks and the foreign banks and large public sector banks, they will go with the SBU approach. The old generation private banks and most of the public sector banks, they will go with the departmental approach. All right. This is the features, and then we have the integrated approach, which is not important for banking. It is a generic approach. It is usually adopted by the smaller businesses. Integration, what is the meaning of integration? Taking into account everything, right? It combines all the socioeconomic aspects. It adopts a cohesive approach, a unified business. So wherever you see the term unified business, go with the integrated approach. All right. This question was asked in the previous year also. where the institute tried to confuse us by giving that there's no division in the departmental approach. No, division is there in the departmental approach as well as the SBU approach. The basis is different. In the integrated approach, there's no division. A unified business with the aim that having an integrated, unified business would reduce the risk, increase the profitability through scale. What is the meaning of scale? Scale means the quantity. So they believe that rather than having separate entities for each business line, we will increase our sales. When the quantity of the product increases, quantity, then our profit will increase. Integration in the sense of mixing SBU and departmental approach, there is no differentiation. I did not integration. Yes, integration means there's no division. We are not dividing the organization. In the SBU approach, we are dividing the organization on the basis of profit centers. In the departmental approach, we are dividing the organization on the basis of functions. In the integrated approach, there is no division. A unified business strategy is followed. There is no division. Clear? The meaning of the three approaches are clear. Everyone? Any doubt, any query, any question? Let's keep the chat interactive. Yes, clear? Okay. Now there is another term which is known as positioning platform. If you're watching this video, you know what is the position, what is my position in Oliveboard. My position is that of a faculty, of a mentor, right? I'm teaching RBWM paper, I'm teaching the CIBB RBL paper, I'm also teaching the banking promotion exam. So my position is what? Faculty. I want to improve my reputation under this position itself. If you look at my manager, they have the position of the manager. Their role or their reputation will increase if they increase the efficiency of the technology team, if they have a better coordination among all the members, right? So, banks also, when they are structuring their retail banking, they have some positioning platform. Their goal, how do they want to establish themselves in the market? How do they want to create an image? Position means image. If a bank wants to be shown as a bank which is basically focusing on the personal needs of the customers, right? Or there's another bank who wants to create their image as they are particularly focusing on the business client. So this is their positioning objective, positioning platform. Now whether the bank will adopt the SBU approach or the departmental approach will depend upon their positioning platform. How do they want to position themselves in the market? Now let us go through the positioning objective of the types of banks. In case of a old generation private banks, they have a very clear positioning platform. They want to increase their size and scale. Previously also we came across this thing, right? The old generation private banks, they have a conservative approach. They want to increase their size and scale. All right, they want to increase their size and scale. The new generation private sector banks, however, they are profit oriented, right? They want to be in the top slot. They are very aggressive, right? They will aggressively promote their products, market their products. They will aggressively reach out to the customers. They adopt the direct selling agents. They appoint the representatives at the various locations, merchant locations, advertisements, placards, billboards are there of the private sector banks. TV advertisements are there of the private sector bank. So they have a very clear vision. They want to be in the top slot across all classes of bank. That is why they go with the SBU, right? They want to have profit in the retail banking, corporate banking, rural banking, everywhere. That is why they have given independence to each of the unit. The technology, strategy, customer, business initiative, aggressive positioning. They want to enjoy the profit and achieve the desired objective. All right, so the old generation banks, they go with their size and scale. They want to increase their size and scale. The new generation private banks, they want to increase their profit. They are very aggressive in their marketing promotion, right? They want to increase their profit in any way possible. They're using the latest technology. And if we talk about the foreign sector banks, they do not go by positioning objective. They purely go by business objective. You do not see any advertisement or promotion of the foreign banks, right? No TV advertisement, no radio advertisement, nothing. All they want to do is increase their profit. How they will increase their profit? What is the difference between their approach? The private sector banks want to increase their profit in all the class of bank, top slot across all classes of bank. They also want to establish them on the ground of India, right? But the foreign sector banks, they will enter a market segment which is profitable. So if the retail banking space is profitable, they will enter, and they will exit if it could not generate the desired level of profit. So they go by the customer, business, and profit target. They select one segment of the overall model or the entire business model. But if it is not profitable, they will exit it. They will shut down the segment. Okay, so again, old generation private banks, even the public sector banks, they want to establish themselves as stable providers, stable financial institutions, scale and size. New generation private banks, they go with profit objective, positioning objective. They want to be in the top slot. They want to be the highest performers. For that, they're aggressive. Foreign sector banks, they just focus on profit, right? Which segment is generating the highest profit, we will enter it. If it is not giving us the desired profit, doesn't matter, we will exit. For example, BNP Paribas, it entered the retail banking space in the 1990s with a full-fledged brand building exercise, but they exited, they quit the space because they found that it was not profitable. Similarly, American Express Bank, they came out of their credit card business. Citibank has quit the retail business in India. It has been acquired by the Axis Bank. So these are the examples. Okay, so if we talk about the business models, yes, Citibank in the credit card, correct. So if we talk about the business models, so old generation private banks and the public banks, they have a positioning platform. They want to position themselves as stable banks, banks that the customers can trust, they can be loyal. So they do not offer very attractive features. They do not go with advertisement and promotion. No, right? New generation private banks, however, they are very aggressive on their promotion, marketing, advertisement. They come out with attractive taglines in the TV advertisement. There are actors and actresses that are working, promoting the product. And the foreign banks, they just go by the profit. There's no positioning platform for them. They do not want an image. They just go by the profit. All right. Okay. We are done with the unit 2. Clear each and every point? SBU approach, departmental approach, integrated approach, their features, meaning, which category of banks have adopted which type of approach, meaning of positioning platform. Clear, everyone? Those who have joined on the YouTube platform? Yes, clear, no doubt. What about the unit 2? Clear? Okay. Others also, please respond. See, this is your final revision. This is your ultimate revision for the retail banking paper. It will make it or break it, right? So if you have any doubts, please ask. Clear? Clear? Great. Yes, ma'am. Clear. Okay. All right. So we are done with our unit 2. Now we are starting with our unit 3, which is applicability of the retail. You want a break? Um, It's just a 2 hour class. We are not taking a break right now. If you want, you can watch the recorded session later on, but we are not taking a break. Okay, we want to complete the whole module A today. All right. So the unit 3. Okay, unit 3 is the applicability of retail banking concepts, distinction between retail and corporate banking, right? So this thing, retail banking has very important features. It offers multiple products, deposit, loan, cards, insurance, investment, securities, etc. through multiple channels of distribution, call centers, branch, internet, mobile banking, kiosk, etc. and to the multiple customer groups, consumers, small business, corporate, etc. All right. So these are the basic characteristics of retail banking. Now, when we are talking about the implementation model, do we have it next? Yes. Okay. First thing, there's something which is known as outsourcing, right? And opposite of it is in-house. In-house sourcing, right? In-house sourcing. Outsourcing means if, let's say, I want to provide technology solutions to schools. For that, I need biometric identification. I do not want to own the technology. I do not want to buy the technology. I will outsource it from a technology platform. Okay, so outsourcing means availing the facilities, availing the resources from outside, right? Another example could be appointing the direct selling agents by the banks. This is outsourcing. Rather than having staff and employees doing the marketing, reaching out to the customers, if the bank is appointing the DSAs, it is outsourcing. In-house sourcing means using your own resources, using your own resources for technology, for marketing, for management, every other thing. Okay. Now, again, recall the concept of Gen Z. The Gen Z, the new generation, they are technologically oriented. They want to do things in a faster, efficient manner without putting in a lot of hard work. They want to go with smart work rather than hard work. So they will go with outsourcing, right? In-house sourcing, the older generation, the more experienced generation, they believe in their own capacities and their capabilities. They want to take time, but they want perfection. So they use their own resources because they trust their own resources. Using this concept, the public sector banks, they use in-house resources. The new generation private sector banks and the foreign banks, they use outsourcing. I hope you can connect, right? So most of the public sector banks, they use in-house resources for their retail banking. Whether we are talking about conducting research and development, or we are talking about pricing policy, or we are talking about the promotions, everything is done in house by the public sector banks. Just for some activities, let's say they do not have the technology, they can use outsourcing for ATMs, credit cards, debit card. What is the reason they do not go for complete outsourcing? The regulatory prescription. RBI says because public sector banks are dealing with the interest of the public, the depositors, right? So RBI says there are restrictions on the employment of DSAs, or there are restrictions on, let's say, white label ATMs, right? So because of regulatory prescription, they do not go with complete outsourcing. They go with in-house resources. In case of old private sector banks, also again old generation, they also go with in-house sources. However, when we are talking about the new generation private sector banks, they have a balanced mix. Not a balanced mix, rather they are a little skewed towards outsourcing. They prefer outsourcing only for a limited process, a limited function. They will use their in-house resources. Otherwise, they will outsource most of its processes. All right. Similarly, when we talk about the foreign sector banks also, implementation model is outsource based. Both front end, back end operations are outsourced, right? Now, this topic is not that important because it can vary from bank to bank. Could be possible that a large private public sector bank is using outsourcing for most of the product, right? But the concept is there in your syllabus, so you need to understand. Outsourcing means using the process, availing the technology, using the resources of the outsiders. They're providing a solution. In-house means using our own resources. All right. Now we come to the most important topic from our module A. One of the most important topic. Understand very clearly. The Boston Consulting Group conducted a study on the retail banking processes, and banks they usually use four types of processes for their product offering. What are these models based on? They're based on the technology and customer interface capability. This is the basic. Now understand. There are four broad classification: horizontal model, vertical model, predominantly horizontal, and predominantly vertical. Let's say there's a bank, ABC Bank. ABC Bank is offering 10 products, right? Five of the products are on the liability side, five of the products are on the asset side. Okay. Now, if we are talking about horizontal model, this means that the bank is not sharing anything across the products. The process model, the information, the technology, everything that is developed separately for each of the product. For home loan, for education loan, for savings deposit, for current deposit. There is no common customer information sharing. There is no technology. And this model is product oriented. All right. So when there is another term, end to end, when there is end to end processing for each of the product or each of the product line, then it is known as the horizontal model. Okay, then it is known as the horizontal model. Then the second model is the vertically organized model. Let's say the out of these 10 products which is being offered by the ABC Bank, across all the products the information is shared. Across all the products the technology is shared. So this vertical model is customer oriented. There is a common centralized customer database used across the product. It is vertically organized model. Is this clear? Difference between horizontal and vertical model. In the horizontal model, end to end processing is done for all the products. It is product oriented. In the vertical model, there's a common customer database, a centralized customer interface which is shared across all the products. Then it is the vertical model, it is customer oriented. Clear? Yes? And then in between these two models, we have a combination, a blend, predominantly horizontal and predominantly vertical. Let's say out of the 10 banks that 10 products that ABC Bank is offering, for 8 products out of 10, the bank has end-to-end processing, and for 2, they are using common information. It is predominantly horizontal. And predominantly vertical means now out of these 10, let's say 8 products have common customer database, and for 2 products, end to end processing is being used. Then it is predominantly vertical, mostly vertical. I did not get a confirmation. Clear? The difference between vertically organized and horizontally organized model. Is it clear? If you want me to explain once again, I will repeat. Yes, Saurav, Ajay, everyone, clear? Okay. Here on the paid platform, practically any bank currently running only with horizontal or vertical? No. Mostly the banks are using predominantly vertical or the vertical model itself. They're having a common customer database. Okay. But the theoretical point says that public sector banks and the old generation banks, they follow the horizontal model. In reality, it is not true. Just this Boston Consulting Group, according to their research and development, they said that public sector banks follow the horizontal model. Okay, okay, I will repeat once again. I will repeat once again. Where do I have space? Okay. See, this is the scale. There are four models: horizontal model, vertical model, predominantly horizontal, and predominantly vertical. When the banks are offering end-to-end solution, product-wise, each of the product has its own pricing, then what is the point of studying this? Because it is given in your syllabus. If you get the answer correct, you will clear your RBWM paper and JIB, and you will get increments and promotions. That's the point of studying this. Okay, coming back. Horizontal model means end-to-end processing, product-wise, the strategies used. There is no customer information sharing, there's no centralized customer database. Okay. Vertical model, it is what it is using a customer centric model. A centralized customer database is being used. Information is shared across product. Okay. Information is shared across all the products. That is the vertical model. If for most of the products end-to-end processing is done, for maximum products end-to-end processing is done, it is the predominantly horizontal. For most of the products, for maximum product, if there is a common centralized customer database, then it is the predominantly vertical model. All right. Very simple, nothing difficult, conceptual, and easy 2 mark question. Trust me. If the institute asks is this question, it will be a 2 mark question. You can easily score it. Okay, so that is the meaning of horizontal model. So what does the horizontal or vertical model depend on? It depends upon the level of customer information available in a single platform in the database for offering multiple products across asset, liability, and other services. So is there a single platform? Is there a central database of customer information available for offering the products and services or not? If yes, it is the vertical model. If no, then it is a horizontal model. Horizontally organized model uses a modular structure, different process model for different products, end-to-end solution product-wise. Vertical model provides functionality across product, customer database orientation, centralized customer database. Again, you just need to remember these keywords, these key terms. And if you see the key terms, these key terms, blindly mark the correct answer. Okay, if you see different process model, end-to-end solution, modular structure, product-wise, any of these terms, it is the horizontal model. If you see functionality across product, customer database orientation, centralized customer database, it is the vertical model. All right. In between them, we have the predominantly horizontal model, which is mostly product oriented with common information for only some product. So if 10 products are there, for 8 it is product oriented. For 2 products there's a common information. In predominantly vertically organized, common information is available for most of the product. For a few products, for 1 or 2 products, they might be sharing the information. All right. Case studies will be asked. Scenario based questions will be asked. Direct conceptual questions were not asked in your three papers. In RBWM also, you can expect scenario and case studies. So you need to remember these key terms. Okay. Now you asked that if there is any bank currently following these type of models, clear demarcation is not there. But according to theory, in most of the public sector banks, horizontally organized model is the standard norm. Obviously, some banks they are using the predominantly horizontal model. There is a level of common customer information available for some products. All right. If we talk about the old private sector banks, the scenario is mixed. The new private sector banks, they follow a vertically organized model. They share the customer information, there's functionality across product. And the foreign banks, it is predominantly vertically organized. Now, even if it doesn't make any sense, if the institute asks you which of the following models is followed by the public sector banks, do not use any other strategy there. Mark horizontal model. If the institute asks you which model is used by the foreign sector banks, predominantly vertically organized. New generation private bank, vertically organized. Old generation, mixed scenario. All right. So these are the things that you just need to remember. Clear, everyone? The four models are clear? Yes? Clear, clear, clear? Any doubt, any query, any question? Okay. All right. So the Boston Consulting Group, it conducted its study, gave the four models depending upon the process, customer information sharing. Another demarcation of models is according to the domain specific, according to the business approach. So there are three approaches that the banks can adopt: segmented approach, geography based approach, classification based approach. The name of the approach tells you the meaning. Segmented approach means the branches are classified. In all the three approaches, the classification of branches is there. In the segmented approach, the branches are classified on the basis of business potential. If a branch is having high profit, it will be a priority center. All right. If the branch is having, let's say, not a very high conversion rates, but they're getting the resources, they're getting the customers on board, it is a resource center. All right, so these branches are positioned as resource center branches, form a part of the overall segmentation. Branches, if the institute asks you in which approach the branches are classified as resource centers, profit centers, priority centers, general centers, then it is the segmentation approach. Okay, segmentation approach. Which type of banks follow this approach? It is the public sector banks. Second is the geography based approach. Retail models are built on the basis of geography, means the area of operation. Area of operation, whether it is a hill area, or it is a tribal area, or it is a plain area. All right, so on the basis of geography and on the basis of population. Classification based approach, the type of branch, whether the branch is a rural branch, a semi urban branch, or a metro branch. So this depends upon their location. All right, this depends upon their location. The approaches of horizontal, vertical, they are more important. These business approach, from the name itself you can identify what are we talking about. All right, so there are two types of models. One we saw about the Boston Consulting Group. Another is this, that is domain specific. Now look at this model, this table. The unit 3, if you have your Macmillan book, if you have your Macmillan book, don't open it right now. It will just waste your time. In your book, the definitions are given. It is described in detail, like what is the process model for the products and services, whether the banks are using in-house resources or they're outsourcing? What is the approach adopted by banks for pricing of the products, in-house or outsourcing? What is the approach adopted by the banks for technology, in-house resources or outsourcing? Very detailed story like things are given in your book that you need not worry about. I have summarized it in the table. So look at this table. For the product development, public sector banks, they use in-house resources, incorporating the market dynamics. The old generation banks also for product development, they do it in-house independently. The private sector banks, new generation private banks also, they do the product development in-house using their own resources. However, the foreign sector banks for their product development, they outsource. Why? Because they do not have a good staff holding, they do not have experienced employees in India. So they will outsource the knowledge and experience. All right. So for product development, foreign banks they go with outsourcing. Public banks, old generation private banks, and new generation private banks, they do it in-house. Product processing. Now there are two models for product processing. It means distribution of their, for example, loan products, asset product. If the bank is allowing the branches to do it independently, then it is known as standalone model. If the bank is telling that from the branches just the customer application will be taken, rest all the processing, sanctioning, disbursement, monitoring will be done by the retail hub, then it is known as the CRPC, the centralized retail processing center. Right? We have this topic in detail, we'll be studying it later on. Right now you just need to remember, for product processing, public sector banks and old generation private banks, they have the standalone model. The new generation private banks and the foreign sector banks, they have the CRPC model. Okay. Then for technology, public sector banks, they have in-house model. For some of the technologies, they can outsource. For example, ATMs, right? Or credit card. Then old generation private banks completely outsourced model because they do not have the technology, they do not own the technology. New generation private banks partially outsourcing, partially in-house model, and the foreign sector banks again completely outsourced. Then if we talk about the pricing, public sector banks, they are restricted by the regulatory restrictions set up by RBI, the RBI Act, the Banking Regulation Act. So it is market driven and competitive. They cannot price their product too high or too low. Okay. Old generation private banks, slightly aggressive. They're slightly aggressive. But the new generation private banks and foreign banks, they are very aggressive. If one private sector banks, if one private sector bank is increasing their price, all the other private sector banks will decrease their price. Why? Because they want to take the customers of the bank that increase their price. They're very aggressive, right? Very quickly they're making changes in the prices. The public sector banks and the old generation private banks, they do not do that. If we talk about the implementation model, public sector banks horizontal or predominantly horizontal, old generation private banks blend of predominantly horizontal and vertical, mostly vertical. New generation private banks vertically organized, and the foreign sector banks predominantly vertical. Is this table clear? Is there any term that you don't understand? Do you want me to explain any term, or is it clear? Please answer. Give me a confirmation. Clear, everyone? Yes? Yes? Okay. CRPC model. Okay, I will explain you the CRPC model in short. Do I have space? Do I have space? Okay. What happens in the CRPC model? Let's say there's a retail hub here. This is a retail hub, a retail factory, whatever name it is being called. There are various branches which are attached to the retail hub, right? What will the branch do? The branch will accept the application of the customer. Let's say the customer wants to avail a home loan. They will do the basics. Take the application, do the identification, forward the application to the retail hub. Similarly, the branch 2, branch 3, branch 4, every branch will do what? Customer onboarding, forward the application to the retail hub. Now, the retail hub will carry on the further actions. They will scrutinize, they will do the credit appraisal, the credit scoring, arrive at the sanction limit, do the disbursement, right? This is known as the CRPC model. Now, there are variations in the CRPC model also. Some banks, they allow the branches only to onboard the customers. Other banks, they might allow the branches to disburse the loan. The credit appraisal sanction will be done by the hub. The disbursement and monitoring will be done by the branch. Okay, that is the CRPC model. In the standalone model, everything is done by the branch itself. Yes, clear, Krishna? Clear the meaning of CRPC? Okay, last topic of our unit 3, the difference between retail and corporate banking. Do you want to participate in the chat? Let me ask you questions regarding the difference. We will see have you understood the meaning or not. Okay. Retail banking targets at the individual segment. Corporate banking deals with the corporate clients. We already know, right? Which banking? Answer, your answer will be R or C. Which banking is a B2C approach? And which banking is a B2B approach? You need to answer which banking is a B2C approach? Retail or corporate? R or C? B2C. Hmm. So retail banking is what? It is a business to customer approach. Corporate banking is a business to business approach. Correct. B2C is retail banking. Okay. Why? We are offering the products and services to the customers. R, great. All your answers are correct, right? And corporate banking is a B2B approach. In which type of banking the ticket size will be low? In which type of banking there will be a low ticket size? R or C? A low ticket size. R or C? Yes, Saurav, correct. B2C approach is retail. In which type of banking the ticket size will be low? R. Retail banking, correct. Ticket size means the quantum of loan. No, not C. Mm-mm. Corporate banking will have a higher ticket size, a large quantum of loan. In retail banking, the ticket size will be low. Okay. In which type of banking the risk is more widespread? Don't try to answer the question quickly. Take your time. Take your time. In which type of banking the risk is more widespread? I have already told you about this in the very beginning of the unit 1. Yes. No, not in corporate banking, in retail banking. Risk is widespread in retail banking. Why? Because there is a large customers database. There is a large customer base. In corporate banking, the risk is concentrated. There are only a few customers and the risk is concentrated. It is limited among the few customers in the corporate side. Yes, the customer base is very large, so the risk is widespread in the retail banking side. Okay, so how many points have we covered? Retail banking targets at individual segment, corporate deals with the corporate client. Retail bank is a mass market model, corporate banking a relatively smaller segment. Retail banking is a B2C approach, corporate banking is a B2B approach. Ticket size in retail banking is low, ticket size is high in the corporate loans. Correct. Okay. Okay. Next, if I ask you, where will the returns be more? Returns will be more. Or if I change the term, where the interest rate spread will be more? In retail or in corporate? In retail or in corporate, returns will be more. In retail or in corporate? Yes, in retail. Great. Why retail? Because the customers, they cannot bargain. In retail side, the customers cannot bargain for a lower rate of interest in the loan or a higher rate of interest in the deposit. I thought you'll answer it wrong, but all of you are answer it correctly. Great. Right? The customers cannot bargain. So the banks have the complete autonomy. They can have large, widespread interest rate. Right? So the spread is wider in the retail banking. The corporates can bargain for cheaper loans. Correct. Okay. Now, hmm, what about monitoring? Where will monitoring and recovery be more laborious and troublesome for the banks? In retail or in corporate? Where will the recovery and monitoring be tough? In retail or corporate? More laborious, tough for the banks. R or C? Retail, Saurav is saying retail. How about the others? Retail, Prabhakar, yes, yes, correct. Retail. Why recovery and monitoring will be laborious? Because again, there is a large customer database. We need to employ more staff towards monitoring. We need to keep a close watch on the behavior of the customers. Okay, so it is more laborious. Large number of customers. True. In the corporate banking, there are only a few customers. We can easily monitor them. We can easily see if there is any disturbance, if there is any delay in their EMI payment. Okay, so which points have we covered? Risk is widespread in retail banking. Returns are more in retail banking. Monitoring and recovery is more laborious because of the large customer base in retail banking. Okay, I think we have one more point. Let us just cover it right here only. Hmm. In the liability side, the cost of deposit will be relatively less in the retail side. In corporate banking, the ticket size of deposits will be large. The cost of deposit will be high. To maintain them, higher cost will be incurred. The impact, however, the impact of NPA will be more pronounced in corporate banking. Why? Because of the high ticket size. If a customer who has taken a loan of only 10 lakh rupees defaults, then a customer who has taken a loan of 1 crore rupees default, obviously this impact will be more. Ma'am, can you schedule 6 a.m.? 6 a.m. in the morning. In the winters, will you be able to attend the class at 6 a.m.? Let me see. Let me see. Okay. Right now for tomorrow, the class is 7:30 a.m. I will check for day after tomorrow. All right. Tomorrow you'll have your class at 7:30 a.m. All right. So the impact of NPA will be more on the corporate side and the impact of NPA will be less on the retail side. Right? So with this we have completed our unit 3. Clear? I will just let you know, Saurav, don't worry. Tomorrow we cannot change it on this short notice, right? So tomorrow you'll have your class at 7:30 a.m. For the further classes. Let me just check. All right? Clear everyone? Any doubt, any query, any question from unit 3? The topics that we have covered? Do you want me to repeat any topic? Is there any term that you don't understand? Anything? Everyone who's watching on the YouTube platform, please like and share the video. And those who are there on the paid platform, you also have the feedback option. You can also give your feedback there. Clear, everyone? Please give me a confirmation. Yes, so that we can start with the fourth and the last unit of Module A. Yes? Okay. So the fourth unit is branch profitability. Now, this unit is important. We have some numerical concepts which are very easy, extremely easy. If questions from numerical questions from this unit are asked, you will easily score 1 mark, 2 mark, whatever is being asked. Okay. First, there is the basic introduction about banking in India. We know that banking in India is regulated by two acts, the RBI Act and the Banking Regulation Act. The Banking Regulation Act of 1949 and RBI Act. Basically, RBI has the powers to supervise the bank. Bank, any company wants to provide the banking business, they need to get their registration with RBI under the Banking Regulation Act. Okay, so the Banking Regulation Act and the RBI Act, they provide the regulatory framework. Now, the Banking Regulation Act, originally, when it was enacted in 1949, it was known as the Banking Companies Act, right? And later on, its name was changed to the Banking Regulation Act 1949 when in 1966. The reason being that in 1949, the corporative banks were kept outside the purview of this act. Okay, the cooperative banks were not under the regulation of RBI. They were not under the provisions of the Banking Regulation Act. So the original name of the act was Banking Companies Act of 1949. Later on, amendments were made. The cooperative banks are now under the supervision and control of RBI. So in 1966, the name of the act was changed to the Banking Regulation Act in 1966. Remember this point. Then, if we talk about the development of the banking sector, we can divide it into three phases. Phase one, early independence, pre-independence, right? From the period 1770 to 1969. In the early period, there were more than 600 banks in India. More than 600 banks in India, out of which only a few survive. We can count 24 banks, 48 banks, we can count the banks. Prior to independence, there were more than 600 banks. But after independence, after RBI getting control over the banks, increasing regulations, the number of banks were reduced. Okay, so the first phase is 1970 to 1969. Second phase is the nationalization phase. The banks were nationalized in two phases. First in 1969, second in 1980, right? 14 banks were nationalized in 1969, and then in 1980, another six banks were nationalized. So the nationalization phase goes from 1969 to 1991 because the government felt that if we take over the financial system, we can better regulate it, we can work for the development of the public. However, it was later on realized that privatization, liberalization, and globalization is extremely important. So the private sector banks and the foreign sector banks were also allowed to function in India. When in the third phase, which is known as the liberalization phase, the banking sector reforms phase from 1991 and it continues till date. I hope you all remember you have studied about it in your IEIFS paper as well. The evolution of banking. Okay, so these are the three phases. Early phase 1770 to 1969 where there were around 600 banks. Then in 1969 to 1991 where the nationalization was done by the government. And the third phase, wait just a second, what went wrong? Yes. And the third phase, which is the liberalization phase, where after the LPG reforms, the Narasimham Committee recommendations, the privatization and liberalization, it started. All right, clear? Okay. So prior to independence, there were close to 600 banks in India. During the British rule, now if we talk about the establishment of SBI, there were three presidential banks in India. Presidential Bank of Kolkata, Mumbai and Chennai. They were merged as the Imperial Bank of India in 1921. All right. So in the British era, there were three banks, presidential banks, Kolkata, Mumbai, Chennai. They were merged into the Imperial Bank of India in 1921. Later on, they were nationalized. The Imperial Bank of India was nationalized and it was named at the as the State Bank of India. All right. So these are the facts that you need to remember about the three phases, about the presidential banks, Imperial Bank of India, and nationalization conversion into the State Bank of India. Then we have the nationalization phase. In 1969, the government decided to nationalize 14 banks. Which banks were nationalized? You need not remember the name. 14 banks were nationalized in 1969. Then in 1980, another six banks were nationalized, totaling to 20. Then the seven subsidiaries of SBI were there. Over the time, they have also been nationalized and they have been merged with SBI. In 2017, the latest merger has been done for the subsidiaries of SBI, right? The subsidiaries of SBI, the Bharatiya Mahila Bank, they all have been merged into SBI. Okay. Then in the final phase, the Narasimham Committee was set up. Narasimham Committee 1, Narasimham Committee 2. The recommendations of the committees you have studied in your IEIFS paper. And during this period, RBI gave out licenses to open the private sector banks, and the foreign sector banks were also allowed, and the licensing requirements were liberalized. It was made easy for the banks to operate. Bank's name were ours in IAFS, but they are not given in your RBWM syllabus. They're not given in your book. They're not given in any notification, so they won't be asked here. Okay? Hmm. So this was the introduction to the banking system. Now we come to the important part of this unit. There is the concept of profit, and then there is the concept of profitability. Okay. Profit. If I'm running a business, right? If I run a business of selling, let's say, toys, and the monthly revenue, the total revenue from this business that I generated was, let's say, rupees 1 lakh. Okay. But to run my business, I also had to incur some expenditure. The total expenditure which was incurred by me was, let's say, 20,000 rupees on the selling of these toys. So what is the profit? Profit simply means total revenue minus total expenditure. So that will be 80,000 rupees, right? That is the absolute profit. Okay. Total revenue minus total expenditure. Absolute terms. Profitability, on the other hand, is a comparison. It is a ratio. Now, here I'm trying to evaluate, I'm trying to analyze. Is my firm, is my shop, is my business profitable or not? When will it be profitable? If I'm able to generate more profit with less expenses. So, it is a ratio. Profitability ratio means the profit divided by the expenses. In the most simple direct terms, this is the meaning of profitability. How much profit am I generating in relative to the expenses that I need to incur? That is profitability. How much profit? That is simply the absolute terms. How much profitability? I am comparing it with the expenses. So, profit will give me a picture, right, of the revenue being generated. Profitability will tell me whether my organization is efficient or not. If I'm able to generate higher profit with lesser expenses by reducing my cost, my organization is efficient. But if to get more profit, I have to incur even more cost, even more expenses, my organization will be inefficient. All right. So profitability is a measure of the organization's profit relative to its expenses. The organizations that can realize more profit as a percentage of my expenses will be more efficient as compared to an organization who has to spend more to generate the same profit. So if the organization A is generating 20,000 rupees profit, organization B is also generating 20,000 rupees profit, but organization A is incurring rupees 10,000 to generate this much profit, and organization B has to spend 17,000 to generate this much profit. So obviously the organization A is more efficient, even though both of them are getting the same profit, right? So when we compare the profit with the expenses, then it is known as profitability. All right. So profitability is the measure of efficiency, ultimately its success or failure. It is the ability of a business to produce a return on an investment as compared to the alternative investment. So I hope you have studied about the this you have studied in your AFM paper as well. Opportunity cost, right? You would have come across this term, opportunity cost. If I am selecting a particular option, I'm leaving the other options. So is this selected option better than the other leftover alternate options or not? It will depend upon the profitability. Okay, so the profitability will help me decide, will help me analyze whether I'm able to produce a return on the investment or not. So profitability is a relative measure of profit. Profit is absolute, profitability is relative. Profit tells me amount of money that I am gaining or I'm earning. Profitability tells me the efficiency of my business. Profitability compares how much profit a company makes compared with its overall revenue and cost to have a more holistic view of how the company is performing. Profit simply means the money that a business pulls after accounting for expenses. So, revenue minus expenditure. Whatever revenue I am getting, if I'm subtracting the expenditure, whatever is left in the absolute terms, it is known as profit, right? Every organization, the main aim is to generate profit. Doesn't matter how small or how big the organization is, right? So for that, we have the different methods to calculate the profit and profitability. Now we will be studying about gross profit, operating profit, and net profit. And then for profitability, we'll be studying about ROA and ROE. Before we start with these concepts, the difference between profit and profitability is clear. If the institute asks you, they give you a scenario. ABC Bank has shown increased profit in the third quarter of the year as compared to the first quarter. Still, the board of directors are worried about the increasing expenses. What can be true about its profitability? So here you can simply go with the profitability concept, the relativity concept. Clear everything? If you have any doubts, then you can obviously ask. So there are three major types of profit: gross profit, operating profit, and net profit. These are found on the income statement, about which you have already studied in your AFM paper. Very simple, very direct, basic MCQs of 1 or 2 marks, numerical MCQs will be asked in your exam. All you need to do is remember these formulae. What is the formula for gross profit? Revenue minus cost, right? Revenue of a firm will be the total sales minus the cost of goods sold. So when you are preparing the balance sheet, the profit and loss account, you have the revenue, you have the expenditure, everything, right? So the total sales that a firm is generating and whatever they're spending on the cost of goods sold, that the difference between them is known as the gross profit. It is the first level of profitability. Sales minus the cost of goods sold, first point that you need to remember. Second point, sales are the first line item on the income statement and the cost of goods sold is generally listed below it, right? So if the total sales of my firm is 1 lakh rupees and the cost of goods sold of my firm is let's say 10,000 rupees, so what will be my gross profit? My gross profit will be 90,000 rupees. The institute will directly give you, this is the total sales, this is the cost of goods sold. Another formula that you need to remember, how do you calculate the gross profit margin? Simply divide the gross profit by the total sales. So if the gross profit is 90,000 and the total sales is 1 lakh rupees, dividing it, you will have the gross profit margin. All right. So revenue minus cost of goods sold is the gross profit. Very simple calculation, nothing typical, nothing complicated. You don't even need your calculators. Then the second level of profitability is operating profit. How do you calculate the operating profit? From the gross profit, subtract the operating expenses. What are the operating expenses? Expenses or cost incurred on the selling, general and administrative cost. Selling cost, packaging, promotion, advertisement, salaries to the employees, rent to be paid. All of these are what? Selling, general, and administrative cost. Okay, so if my gross profit was 90,000 rupees and the operating expenses are, let's say, 8,000 rupees, so what is left with me will be my operating profit. All right. This is how you calculate the operating profit. How do you calculate the operating profit margin? Simply divide the operating profit by the total sales. All right. So this will give me the answer. It will be 82,000. How do you calculate the operating profit margin? 82,000 rupees divided by 1 lakh rupees, which is my total sales, will be my operating profit margin. All right. So remember, gross profit is the first level. Obviously, the gross profit will be more than the operating profit. Okay. From the gross profit, subtract the cost of goods sold, operating profit. From the gross profit, no, wait. From the total sales, subtract the cost of goods sold, gross profit. Divide the gross profit by total sales, gross profit margin. From the gross profit, divide the operating expensive, selling general administrative costs, you will have the operating profit. Divide the operating profit by the total sales, you will have the operating profit margin. Do not skip the numerical questions from these topics. These are easy to mark questions, easy. Okay, we'll be practicing numericals in the morning session tomorrow. And the final or the third level of profitability is net profit. Income left after all the expenses, including taxes and interest, have been paid. Now, the institute will not give you easy question. How will the institute try to confuse you? They will give you a lengthy question. They will ask you to calculate gross profit, operating profit, net profit, everything. They will give you each and every detail, right? But they do not know, the institute does not know you have practiced all the formulae. You remember all the formulae. So you can easily take your time. You have 2 hours more than enough, right? So how do you calculate the net profit? From the operating profit, subtract the taxes and the interest, right? So let's say the operating profit was 82,000. I had to pay 5,000 rupees interest on the loans that I had taken. I also had to pay 5,000 rupees taxes to the government. So this will be subtracted. So from 82,000 rupees, subtract 10,000 rupees, 72,000 rupees is left, and this is my net profit. Bottom line. Net income and net profit is the same? No. Net income and net profit is not the same. Net income means the interest that the bank earns on the asset minus the interest that they pay on the liability. Net profit will also include the capital of the owners. It will also include the fees, every other thing, right? So it is not the same. They are different. All right? Yes. Clear? So this is how we calculate the three levels of profit. From the revenue, subtract the cost of goods sold, you have the gross profit. From the gross profit, subtract the operating expenses, you have the operating profit. From the operating profit, subtract the taxes plus the interest you pay on the loans that you have taken, on the debt that you have acquired, you will have the net profit. First line of profitability is the gross profit. Second line is operating profit. And the bottom level, third line is the net profit. Clear, everyone? Right? The institute will ask you theoretical questions. The institute will also ask you numerical questions. Whatever is asked, you have the conceptual clarity, you will get it right. Yes? Clear, everyone? Any doubt, any query, any question? Do you want me to repeat anything? Or is everything clear? Simple subtraction. What if the institute reverses the question? The institute, for example, gives you the operating expenses and they give you the gross profit. They ask you to calculate the operating profit from there. That is easy. If the institute gives you the cost of goods sold and the institute gives you the gross profit, they ask you to calculate the total sales. Easily you can do that. If the institute gives you the gross profit margin, from that they ask you to calculate the gross profit and they have also given you the total sales. Again, very simple, right? So whatever is asked, in whatever manner the institute complicates the question, you can easily solve it if you remember the formula, if you remember the concept. Now we come to the last topic of our module A and the unit 4, the traditional methods of profitability, ROA and ROE, return on assets, return on equity. Okay, so banks, if they want to measure their profitability, they will see how much returns they are able to generate on the assets that they are creating. How do the banks create asset? What are the asset for the bank? The loans that they are giving. On these loans, they are earning interest. So these are the asset. What are the ways the banks can give out more loans? Either by liabilities. Liabilities are the deposits that they take, right? The banks are liable. The banks are the debtors of the depositors. They need to pay back these deposits to the customers. So either by increasing the deposits, by having more liability, or by using the owner's capital, right? Or by using the owner's capital. So assets will be created. Assets is equal to the liability plus the owner's capital. Both these can be used for creating more assets, right? But the banks, they mostly want to increase their deposits because if they wipe out, if the complete owner's equity, it will be shut down, the bank will be shut down. So we are focusing on the return on asset. The return on asset will be high if the bank is able to generate more interest, if they're able to earn higher interest as compared to the interest that they have to pay on the deposit, right? This is the interest rate spread. Interest rate spread means the average interest rate received on the asset, the interest rate that the bank charges on the loans, minus the average interest paid on the liabilities, paid on the savings deposit and the fixed deposit. If the difference is positive and more, the banks will have a higher interest rate spread. If let's say the bank is able to charge 10% on the loans on an average, and the bank is offering on an average only 6% rate of interest on the deposit, so the interest rate spread is positive. If let's say the average interest rate offered on the liabilities increases to 8%, so the interest rate spread will be only 2%, it will reduce, right? So what is the meaning of the interest rate spread, or simply interest spread? Average interest rate received on an asset minus the average interest rate paid on liabilities. Okay, now this is the average value. Net interest income, absolute difference, interest received on asset minus the interest paid on liability. Simple, right? Here we are talking about the average, so it is the interest rate spread. When we are talking about the net interest income, we are taking the absolute value. We can divide the assets into the securities and loans. We can divide the liabilities into the deposit and borrowing, right? So the interest earned on the securities created by the banks and the loans offered by the banks minus the interest paid on the deposits created by the bank and the borrowings taken by the bank. This is the net interest income and the interest rate spread. Then if we have the net interest income, then from that we can simply calculate the net interest margin. Margin means the difference. Okay. Net interest income. The interest that the bank earn on their asset minus the interest that they pay on their liabilities divided by the average total asset. Average total asset means the assets which were there in the beginning of the fiscal year and the assets that were there at the end of the fiscal year. So the total assets at the start of the fiscal year plus the total assets at the end of the fiscal year divided by 2. This is the average total asset. Each of these formulae are extremely important. They are very simple, but they'll be simple only if you remember them. Okay, so how do you calculate the net interest margin? Divide the net interest income by the average total asset, right? So three formulae till here we have discussed. And finally, we have the formula for return on asset, which is the net income divided by the average total asset. What is the net income? Income that the banks earn on the fee, income that the banks they earn on the assets that they create minus they have to pay. So the net interest income, right, divided by the average total assets. This is the return on asset. How much the bank is able to generate, how much profit the bank is able to generate on its asset. That is the return on assets. Okay, we can further elaborate this equation. ROA is equal to fee income plus the net interest income minus the operating cost divided by the average total assets, or simply the net income divided by the average total asset, right? So till here, how many formulae you need to remember? You need to remember the interest rate spread, you need to remember the net interest income, you need to remember the interest margin, right? The net interest margin. And finally, you need to remember the ROA, also the average total assets, right? Assets at the start of the fiscal year plus assets at the end of the fiscal year divided by 2. Why do we take the average total assets? Because income is calculated over a period of time. It is a flow concept, but assets in our balance sheet, they are a stock concept at a point of time, at a particular point of time. If I ask you how much income has increased, how much income has increased from 2010 to 2025? It is a flow concept. That is why over a period of time. How much stock do you have? How much inventory do you have today on 9th of November 2025? It is a particular point of time. So that is why it is a stock concept. You want it in a form of chart? All right. Before uploading the PDF, I will give you all the formulae in one single chart. You can use it for your revision. I will do that. Okay. So this is the concept of ROA. ROA tells me how much profit the bank or the organization is able to generate on the assets that it creates. Second concept is the return on equity for the banks. Equity means how much investment the owners have made, the shareholders. How much investment, how much capital. Every bank is created with a paid up capital. There is the shareholder capital, right? Whatever capital is invested, why would someone invest? Because they want to get a return on it. Now, the bank owners are primarily interested in the return on equity because this is the return that they earn. Okay. Now, either the banks can create more assets by increasing their liabilities, or they can use the owner capital. The increasing of liabilities is possible, but to a certain extent. Why to a certain extent? Because when, let's say, the total deposits that are created by the banks are 5 crore, out of this 5 crore, the banks will also have to maintain the cash deposits because the customers will come to make withdrawal. They also need to maintain the SLR and CRR, cash reserve ratio, statutory liquidity ratio. Banks, they also need to do the provisioning for the substandard asset, the NPAs, even the standard asset. So they cannot use the complete liability amount. They cannot use the complete deposit. Otherwise, bank run situation can be created. So what they will do, they will also use their own equity, right? Obviously, if the owners want to earn a greater return, they would use liabilities rather their own capital. But using their liabilities is also restricted. When the bank is increasing the liabilities to pay for the asset, liabilities means deposit as well as the debts of the bank. It is using leverage. Otherwise, it would be the returns would be limited to what the bank can charge on the loans and the fee that they can charge. Again, the bank cannot charge a very high interest rate, nor they can charge a very high fee on the products. There are restrictions imposed by RBI. There are the market forces. Because of that, banks can do what? Banks will use their equity. These are the various reasons why we study the return on equity. Okay, interest rate spread is limited by what the bank must pay on its liability and what it can charge on the asset. Again, the banks, they compete with the depositors, so they must pay the competitive market rate of return. Also on the fees also, or on the loans also, the banks can charge only that much limit which is specified by RBI. So the interest rate spread are not very wide. Thus the bank can earn more income by increasing the number of loans as compared to the amount of the bank capital, right? How much of the bank capital is being utilized to create more loan? This is leverage ratio, or which is also known as the debt ratio for organization. What is leverage ratio? The total bank assets divided by the total bank capital. Leverage ratio tells me how much bank assets are being generated as compared to the bank capital. There are also limit. Obviously, increasing leverage will be profitable for the bank. Taking more loans or giving out more loans, accepting more deposits, leverage is beneficial. But if a very high leverage is created as compared to the bank capital, the bank will be incapable in paying off the debt. Let's say the bank has taken a loan of 50,000 rupees, but the bank capital is only 10,000 rupees. 5 is to 1. This is a very bad ratio. Okay, so leverage can also be increased to a certain limit only. To a certain limit only. So from here, you need to remember the formula for leverage ratio, bank assets divided by the bank capital. Now we can very easily calculate the return on equity, the return on asset multiplied by the leverage ratio. What was the return on asset? Net income divided by the bank asset. What is the leverage ratio? Bank asset divided by the bank capital, right? Net income or the bank capital, it can be cancelled out. All right, so we will have the return on equity, right? Bank asset cancelled out. We are left with the net income divided by bank capital. So either you can use this formula, ROE is equal to ROA multiplied by the leverage ratio, or you can use this formula, net income divided by the bank capital. Clear? So what do you need to remember from here? The formula for leverage ratio and the formula for ROE. Clear, everyone? The calculation of ROE is clear? Yes, I will give you the formula. When I upload the PDF, you'll get the chart for the formula for your revision. Just that you need to remember how we are calculating each and everything. Don't worry about the numericals. In tomorrow's YouTube session, we'll be practicing the numericals as well. Clear, everyone? Please confirm. Yes? Now, I told you that the leverage ratio cannot be very high. A healthy leverage ratio has to be maintained by the banks. Otherwise, a situation of bank run can happen, like what happened with the global financial crisis, the Lehman Brothers crisis. They had a leverage ratio greater than 30. This means the value of assets only had to decline 3% to wipe out their complete entire capital. The 2008 subprime mortgage crisis, right? They gave out easy loan. Gave out home loans on easy mortgage terms. Most of the borrowers, they defaulted, and it led to a crisis situation for the whole world, right? So these are the formula that you need to remember. Other than this, in your unit, what are the factors that affect the branch profitability? Channel optimization, business alignment, process cost, staff productivity, basic things, nothing important. How can you increase your profitability? Using the new technology, leveraging the staff productivity, or maybe incentivizing them, giving them training, all of this will increase their profitability. What are the factors affecting the profitability of banks in India? You need to remember three factors. There are the macroeconomic, you have studied about micro and macroeconomic. Macroeconomic means national level factors, right? GDP growth, if the GDP is growing, profitability of bank will increase. If inflation is growing, negative, there will be negative impact on the profitability, right? Interest specific factors, if there are more NPAs, it will lead to an adverse impact on the profitability. It will reduce the profitability. If, however, RBI is giving more autonomy to the banks to decide their own operations, it will have a positive factor on the profitability. Other bank specific factors, non interest income, service charge, guarantee fee, net income, foreign exchange profit, all of these factors, they affect the profitability of the banks. And with this, I think we have, yes, we have completed our module A. We have completed our module A, all the 4 units, the formula, theory, concepts, everything. Clear? Any doubts, any queries, any questions? Or is everything clear? Again, I will repeat. From module A, you can expect maybe 10 to 15 mark questions. Okay? Numericals can be asked from the module A, which will be very easy. And the concepts from the horizontally organized model, vertically model, SBU integrated approach, departmental approach, these are asked every time. Now tomorrow at 7:30 a.m. on the YouTube channel of Oliveboard JIB CIB English Medium, we'll be having the practice session. We'll be practicing all the important MCQs, numericals, case studies, everything from the module A only, right? And after this, this was your demo session, so it was available on the YouTube. After this, from tomorrow at 7 p.m., we will be having only the paid classes. 7:30 a.m. YouTube class, 7 p.m. paid class. Tomorrow at 7 p.m., we'll be starting with the module B. All right. So those who are there on the paid platform, before you leave, do give me your feedback about the class. The feedback option, a thumbs up is given on your screen, right? So there you can give me your feedback. Those who are there on the YouTube platform, join the capsule batch, the rapid revision. Go on the Oliveboard platform if you want to attend the paid classes. And the remaining YouTube classes are obviously free of cost daily morning. All right, please like the video, share the video. If you have any doubts, any queries, anything, comment down below. So, shall we end the session now? Please give me a confirmation, everyone. Is it fine if we end the session now? Everything is clear? I will be uploading the PDF. Those who are there on the paid platform, you will get it on the download option. Those who are there on the YouTube, go on the Oliveboard app or website under the courses, you will get the YouTube sessions. From there, you can download. All right. So now I will see you all in the morning, 7:30 a.m. Please make sure to attend the YouTube session. So thank you so much. Good night. Take care. All the very best. And we will meet tomorrow now. Take care and do the revision tomorrow. It is also important that you take a good sleep. Right? Okay. Thank you, everyone. Good night and take care. Do give me your feedback about the class before you leave. Thank you.